It's based on data tutorial academy channel in the fields of financial planning, personal finance and financial management, and asset allocation, portfolio management, and investment on corporate bonds and government bonds, and banking instruments, banking financial products like fixed deposits, term deposits, and multi-option deposits, and national savings certificate, and public provident fund, and NPS, national pension system, as you all know that. So we deal with that investment in mutual funds, stock markets, equity, debt hybrid, multi-cap, flexi-cap, and aggressive hybrid, and large cap, small cap. So there are lots of subcategories in mutual funds too. So there's no time to introduce about at this point of time. So this time we are going to learn about how to utilize fixed assets and uh, fixed assets utilization and returns on investment. We are going to learn returns on investment. Okay, so I think that we can move forward. Sorry. So here we see that fixed assets utilization. So how to utilize fixed assets? We know that assets are we know that fixed assets like land, building, plant, and machinery. Okay, and there are lots of that. So fixed assets is the most important assets required in every business. So how to utilize them? Utilization of fixed assets. So for instance, let's take a look at this. Suppose this is, let's call this is a company, okay? A company, and what shall we put the name? Let's put Y Limited, Y Limited Company, okay? So this is fixed assets. Let me write in the short form, fixed assets. So this is building. As we already mentioned that fixed assets are land, building, plant, machinery. Yeah. Okay. So this is a building, fixed assets. Okay. And this Y limited invested in this fixed asset, invested in this fixed asset rupees 200 crore. Okay. 200 crore. So here ROI we got. This is returns on investment. This is very important, okay? Returns on investment. Before you put your idle cash or your hard-earned money cash into any types of investment category or platforms, you have to research that how much return you're gonna get at the time of maturity period, maybe 3 years, 5 years, 7 years, 10 years, 20 years. So how much return you're gonna get? So this is very important, return on investment. how to compare, how to measure, and how to expect and how to analyze strategy. Okay, here also Oil Limited invested on this fixed asset rupees 200 crore on the expectation of 50, no, sorry, let's say 20%, okay, 20% return on investment. I'm writing in short form, so try to remember that, okay. So this is the return on investment expectation. This is not just expectation, not actual result, okay. So we got here, we may say that profitability is 20%, and we got fixed assets 200 crore, 200 crore, and sales. Let's put sales. How much gun sales? Okay, let's put 50 crore. Sorry. So the profit margin here, the profit margin and profitability of the business is similar only, okay. Profit margin is profitability of the business. The term is similar, so 20%. So here profitability 20% and profit margin 20%, okay. So a company called Well Limited has invested in this project, and let's say it's a big project like, see, like land, building, plant and machinery. It's a big project. So they have taken this investment with an expectation of 20% return on investment. So out of 200 crore, out of this 200 crore, or out of this 200 crore, 20%, let's assume here, out of this 200 crore, 20% return on investment is 40 crore. How come this 40 crore? So we got here 40 crore. Okay. Let's say if the business made 40 crore, then the expectation was met. Okay. So 40 crore here. If the business made this, if the business made this, the expectation was met. The expectation was 20% return on investment. So 20% return on investment is 40. So expectation was got. Okay. So this business has profitability of 20%. That means profitability of 20% means for every sales they make profit of 20% here. Profitability. Profitability of 20% means that every any sales they make, okay, any sales they make, they get from that sales, they get profit of 20%. Any sales, any sales, or from that sales, a profit they make must be 20%. That is profitability of 20%. Okay. Suppose if they are selling for rupees 100, here they sell for rupees 100 and make profit of rupees 20. Profit rupees 20. Or if they sell for rupees 300, sell for rupees 300 and they make a profit of rupees 40. Okay, so up till now I think everything is clear. There's no doubt fixed assets utilization. We know that what is fixed assets. Fixed assets are land, building, plant, machinery, and this is a company, Y Limited company, and return on investment. Y Limited company invested on fixed assets, building. This is a big project, okay? Invested, Y company invested on this building costing rupees 200 crore, and the expectation the return on investment is 20% and profitability is 20% and fixed assets is 200 crore and sales is 50 crore and profit margin is 20%. So here out of 200 crore 20%, so 40 crore. So the expectation was met in this type, okay, at this point of time. Let's move on. This is the company, the same one, company Y Limited. Here the building, okay. This is the building. This is the building fixed asset. Here company Y invested rupees 200 crore. We have already pointed out and mentioned all about their things. So now let's move to the expectation that return on investment expectation rate is 20%. We should remember, we must remember this. So now fixed assets are 100 crore and the sales is 50 crore and profit margin on profitability is 20%. Then profit for this business is, so here the sales is 50 crore, sales is 50 crore and profit margin is 20%, and the profit for this business is 50 into 20 by 100 equal to 10%. So at this situation, the investor will not be happy. See, the expected return on investment is 20%, but here we got only 10%. So the expectation is very less. It's only 50%. So the investor won't be happy at this situation. Well, expecting the return on investment is 20%, but the profit margin is only 10%. So sure, the investors will not be happy in this situation. So let's see another scenario here. Another scenario, we got fixed assets rupees 200 crore and sales rupees 120 crore, and profit margin is profitability of the business is 20%. So what is the profitability of the business? 120 into 20 by 100 equal to 424%. Okay, so here the expected return on investment is 20% and the actual result is 24. So the expected return on investment is less than the actual result. So at this situation, the investor will be overwhelmed and the investor will be very happy. Okay. So in this situation, the investor will be very happy since the profit margin or profitability is 20% and actual profit for this business is 24%, and the expected return on investment is 20%. So profitability of the business and return on investment expected this one expected is 20%, and at the end of the period the actual return is 24%. So investors would be very happy plus content. Okay, so now we got this. Here the company well limited invested in the fixed assets, big project, huge project, rupees 200 crore, and expected return on investment is 20%, sales 50 crore, and profit margin 20%. So here we got only 10%, expected return is 20%. So this actual result is profitability of the business is 10% only. So in this situation, the investor won't be the investor unhappy. Okay. So here another scenario, fixed 200 crore, sales 120 crore, and profit margin 20%. So here sales into 20% equal to 24%. So expect that return on investment is 20%, and actual result we got or actual profitability of the business is 24%. So its actual result is greater than expected return on investment 20%. In this situation, the investor or the investors would be very happy and contented. Okay, that's all for this time. Thank you so much for watching, and please do continue watch my channel and follow, like, share, and subscribe if you don't do it. So if there is any doubt or unclear or any questions or any problem issues, so feel free to express. Don't hesitate in doing that. Always welcome any feedbacks, any comments. Thank you so much. Bye bye.